There is a specific IRS notice called a CP-210. It arrives in a standard white envelope with a return address from the Department of the Treasury, and if you have never seen one before, you might not even open it the same day it arrives. But inside is a penalty charge that most of the people who receive it had no idea they were going to owe, and it's not because they failed to pay their taxes, but because they paid them the wrong way at the wrong time using a calculation method the IRS considers incorrect. Quarterly estimated taxes are not complicated in theory. If you work for yourself, the federal government expects you to pay your income tax 4 times a year instead of once in April, the same way an employer withholds money from a paycheck throughout the year. The mechanism is straightforward, and the penalties for getting it wrong are not small, and the 5 specific mistakes that trigger those penalties are ones that millions of freelancers make every year without any awareness that a rule exists to catch them. Every one of the 5 mistakes in this video involves a specific IRS threshold, a specific deadline, or a specific calculation the IRS uses to determine whether you underpaid. By the time this video is finished, you will know exactly where the lines are, how close to them most freelancers accidentally land, and what the ones who never get penalized do differently. The first mistake is the one that catches people who think they are doing everything right. Before we go any further, a clear note on what this is. Everything covered here comes directly from IRS publications, the Internal Revenue Code, and public tax guidance. This is financial education, not personal tax advice, and your actual situation involves details that a video cannot account for. Before you make any changes to how you handle estimated taxes, take this information to a CPA who works specifically with self-employed people. That conversation is worth having, and this video is designed to make it a much more productive one. Mistake 1 is about the safe harbor rule, which is a specific IRS protection that most freelancers have heard of and almost none of them can explain precisely. Mistake 2 is about how income timing across the 4 quarters creates a penalty even when the total annual payment is correct. Mistake 3 is the gross versus net calculation error that causes people to overpay their estimates and still owe a penalty. Mistake 4 involves the September deadline, which is the one that consistently catches people off guard. Mistake 5 is the overcorrection trap, where trying to fix a shortfall in the 4th quarter actually makes the penalty larger, not smaller. Each one has a real number attached to it, because that is the only way to understand where the IRS actually draws the line. The safe harbor rule is a provision in the tax code that says, in plain language, if you pay enough in estimated taxes throughout the year, the IRS cannot assess an underpayment penalty even if you end up owing more when you file in April. Think of it as a floor. As long as your payments land above that floor, the penalty mechanism does not activate, regardless of what your final tax bill turns out to be. The IRS is not trying to catch you. It is trying to make sure the government receives money on a predictable schedule. Safe harbor is the proof that you participated in that schedule adequately. For most freelancers, the safe harbor threshold has 2 possible versions, and the one that applies to you depends on how much you earned in the prior year. If your adjusted gross income in the previous year was $150,000 or below, the IRS requires you to pay in at least 100% of your prior year's total federal tax liability. Adjusted gross income, by the way, is your total income from all sources minus specific adjustments the IRS allows. Things like contributions to a self-employed retirement account or health insurance premiums you paid as a self-employed person. It is not the same as your taxable income, and it is not the same as what you deposited into your bank account. It is a specific number that appears on line 11 of your Form 1040 from the prior year. If your prior year adjusted gross income was above $150,000, the threshold shifts. You need to pay 110% of your prior year's tax bill, not 100, to qualify for safe harbor protection. That 10 percentage point difference catches a large number of freelancers who had a strong year, earned more than $150,000, and assumed the standard 100% rule still applied to them, which it does not. The mistake that triggers the penalty is not failing to know about safe harbor, but calculating it correctly, and then applying it to the wrong number. A freelancer who paid 100% of their prior year tax liability, but forgot to check whether their prior year AGI crossed the $150,000 threshold can end up in an underpayment situation without having made any error in their arithmetic. They ran the right formula against the wrong threshold. Safe harbor becomes especially valuable when your income is growing rapidly, and this year looks like it will be much larger than last year, because it gives you permission to base all 4 of your estimated payments on last year's tax bill, pay that amount in, and not worry about the rest until April. You might owe additional tax in April, but you will not owe a penalty, and many freelancers with high-growth years overpay every quarter trying to track their current income in real time when they could have used last year's number as a clean, simple target and avoided the entire calculation problem. Verify current income thresholds for safe harbor at irs.gov each year, as they are subject to adjustment. Understanding safe harbor also means understanding what it does not protect you from. It removes the underpayment penalty, but not the tax you owe. So if you had a much larger year than the prior year and relied on safe harbor, you will still owe the difference in April. Safe harbor is not a way to defer your taxes indefinitely. It is a way to avoid the additional fee the IRS charges for paying on the wrong schedule. Most people who understand estimated taxes at a basic level think of them as an annual obligation split into 4 pieces. They imagine the IRS looking at December 31st, checking the total paid in, and comparing it to the total owed. That is not how the penalty calculation works. The IRS evaluates each quarter independently. A shortfall in the first quarter creates a penalty for the first quarter, and paying extra in the fourth quarter does not cancel it. The extra payment in Q4 reduces what you owe in April, but the penalty for Q1 has already accrued, and it cannot be retroactively eliminated by later payments. The 4 quarterly deadlines for 2026 are April 15th for Q1, June 16th for Q2, September 15th for Q3, and January 15th of the following year for Q4. These dates are not the same distance apart, which matters because income for freelancers is rarely earned at a steady rate across all 12 months. A designer who lands a large contract in March might earn 60% of their annual income in the first quarter and almost nothing in the summer. Under the standard quarterly tax approach, which assumes income is earned evenly across the year, that designer would owe a substantial Q1 payment that reflects their income accurately. But if they instead spread their estimated payments evenly across all 4 quarters to make the math simpler, the Q1 payment would be too low even if the annual total is exactly right. The penalty rate the IRS charges for underpayment is tied to the federal short-term interest rate plus 3 percentage points, and it is calculated separately for each quarter where a shortfall exists. In recent years, that rate has run between 7 and 8% annualized, applied proportionally to however many days the underpayment existed within the quarter. On a $5,000 shortfall for a single quarter, that can mean a penalty of $80 to $120 for that quarter alone, and if all 4 quarters carried a similar shortfall, the annual penalty adds up to something that would have been entirely avoidable. Verify current penalty rates at irs.gov, as they adjust with changes in the federal short-term rate. The solution to this problem is not to track your income obsessively week by week and adjust every payment with precision. Most self-employed people do not have that kind of time, and it is not necessary. The solution is either to use the safe harbor method described in the previous section, which eliminates the quarterly calculation entirely, or to use the annualized income installment method, which is a specific IRS procedure that lets you match each quarterly payment to the income you actually earned in that period, rather than assuming it was spread evenly. The annualized income installment method requires filing Form 2210 with your return, and it is worth asking a CPA about if your income fluctuates significantly by season or by project cycle. When a freelancer first starts paying estimated taxes, the most natural instinct in the world is to look at what landed in the bank account, take a percentage of it, and send that to the IRS. It is intuitive, it is the number you see, and it overstates the income the IRS actually taxes by a meaningful amount in almost every case, because that bank deposit is revenue, not profit. The IRS taxes what is left after your legitimate business expenses are subtracted. A freelance copywriter who invoiced $80,000 in a year and spent $18,000 on business expenses, things like software subscriptions, a portion of their home office costs, professional development, equipment, and client-related travel, has a taxable business profit of $62,000, not $80,000. That $18,000 difference is subtracted on Schedule C before any tax calculation begins. Schedule C is the form self-employed people use to report business income and expenses to the IRS. It is essentially a profit and loss statement that feeds into your overall return. The number that actually gets taxed is the net figure at the bottom of Schedule C, not the gross revenue at the top. The practical impact of this mistake is a freelancer who consistently overpays their quarterly estimates by sending in tax calculated on their gross revenue, then receives a larger-than-expected refund in April and treats it as a good outcome, which it is not. That refund represents money they gave the government as an interest-free loan for months, money that could have been sitting in a high-yield savings account earning returns on their behalf. On an $18,000 expense base, the difference in quarterly payments can run $1,500 to $2,500 per year, depending on their effective tax rate, and that money has a real cost when it is sitting idle in an IRS account instead of working in their favor. The correct approach is to track business expenses throughout the year, estimate your net profit at the time each quarterly payment is due, and calculate your estimated tax on that net figure rather than your revenue. A simple spreadsheet updated once a month is sufficient, and while accounting software makes this considerably easier, the core habit you need is simply separating revenue from profit before you calculate what you owe. There is also a second layer to this calculation that many freelancers miss. Self-employment tax, which is the combined Social Security and Medicare tax that self-employed people pay, is calculated on a different base than income tax. When you work for an employer, they cover half of this tax, and you cover the other half through payroll deductions. When you work for yourself, you pay the full amount, which is 15.3% of your net self-employment earnings up to the Social Security wage base. But before that calculation happens, the IRS allows you to deduct half of your self-employment tax when calculating your income tax. You calculate your gross self-employment tax first, take half of that number as a deduction on your income tax, and then calculate income tax on the reduced amount. This two-step calculation is easy to miss when estimating quarterly payments, and ignoring it means your income tax estimates will consistently run higher than they should be. If you found this section useful, subscribing to this channel means you will see the next video in this series as soon as it is available, and the topics ahead go deeper into exactly these kinds of mechanical tax details that most financial content never covers precisely enough to be actionable. September 15th is the deadline that gets freelancers more reliably than any other, and the reason has nothing to do with carelessness. It has to do with the structure of the calendar and a mental accounting error that is almost automatic if you have not thought through the quarterly schedule carefully. Q1 is due April 15th, Q2 is due June 16th, which is only 2 months later, Q3 is due September 15th, which is 3 months after Q2, and Q4 is due January 15th of the following year, which is 4 months after Q3. The gaps are unequal, and critically, the period of income each payment is supposed to cover is also unequal. The Q2 payment covers income earned from April through the end of May. The Q3 payment covers income earned from June through the end of August, which is a full 3-month stretch, and a freelancer who earned substantial income through July and August, which for many design and development freelancers is a peak billing season, can find themselves looking at a Q3 payment significantly larger than their Q1 or Q2 payments without having thought through why. The September 15th deadline also falls at a time of year when attention drifts. Summer travel, irregular work schedules, and the general sense that the tax year is not over yet can all push the September payment to the back of someone's mind. Unlike April 15th, which carries a cultural weight that reminds nearly everyone to act, September 15th arrives quietly. And for freelancers who do not have calendar reminders set and money set aside in advance, it can pass unnoticed. The penalty for missing the Q3 deadline starts accruing the day after September 15th. It is calculated at the same underpayment rate used for other quarters, but because the Q3 underpayment often sits for several months before someone notices and corrects it, the accrued penalty can be larger than for an equivalent shortfall in an earlier quarter. The fix is mechanical and simple. Put September 15th in your calendar right now, alongside April 15th and June 16th and January 15th, and set a reminder 2 weeks before each deadline so you have time to calculate the payment rather than scrambling the morning it is due. Most financial content about quarterly taxes never mentions this, because it sounds technical, and most writers assume their audience will not want to deal with it. The IRS built a procedure specifically for people whose income is not evenly distributed across the year, and using it correctly can eliminate a penalty that would otherwise be unavoidable under the standard calculation method. It is called the annualized income installment method, and the way it works is this. Instead of dividing your prior year tax bill into 4 equal payments and sending those in on the standard schedule, you calculate each quarterly payment based on the income you actually earned in that specific period of the year, then annualize it to estimate the full year equivalent. Think of it as telling the IRS a more accurate story about when your money arrived. A freelancer who earned $70,000 between January and May and almost nothing in the summer does not have an income pattern that fits neatly into equal quarterly installments. The annualized income installment method lets them pay more in the high-income quarters and less in the low-income quarters without triggering an underpayment penalty for the quarters where they paid less. To use this method, you need to file Form 2210 with your annual return. Form 2210 is the IRS worksheet for underpayment of estimated tax. It lets you show the IRS your quarter-by-quarter income pattern and prove that your payments tracked your actual earnings appropriately. Without that filing, the IRS assumes income was earned evenly and applies the standard penalty calculation, and with it, the seasonal or project-based nature of your income becomes a valid basis for the uneven payment pattern. This is not a strategy that benefits every freelancer. If your income is relatively consistent month to month, Safe Harbor is simpler and achieves the same result. But for people who have dramatically uneven income seasons, and that describes most freelancers who work in project-based or contract-based businesses, the annualized income installment method can reduce or eliminate a penalty that the standard approach would generate automatically. A CPA who works with self-employed clients will know this method immediately. The fact that most freelancers have never heard of it is exactly the kind of information gap that costs money without any good reason. A freelancer who reaches October and realizes they have underpaid the first 3 quarters of the year will often do something that feels completely logical. They send a very large Q4 payment to cover the shortfall. They figure that if they pay the full amount they owe by January 15th, the IRS will see a complete payment and the penalty situation will resolve itself. That is not how the IRS penalty calculation works, and sending a corrective Q4 payment that is significantly larger than it should be creates a second problem on top of the first one. The IRS penalty for underpayment is calculated on each quarter independently, as described earlier in this video. A Q1 shortfall creates a Q1 penalty, and a Q2 shortfall creates a Q2 penalty. And those penalties accrue from the dates the payments were due and continue accruing until either the tax is paid or the return is filed and the IRS finalizes the bill. Sending a large Q4 payment in January stops further accrual on the original shortfall amounts, but does not eliminate the penalty that already accrued for the months where the underpayment existed, and that penalty will appear on the CP 210 notice that arrives after processing. Beyond that, if someone sends in a Q4 payment that is dramatically larger than a quarter's worth of estimated tax, they have effectively overpaid for Q4 while still having underpaid for Q1 through Q3. The overpayment becomes a credit toward their April bill or a refund, but it does not retroactively fix the quarterly payment schedule the IRS is evaluating. They end up with an unnecessary refund on one hand and a penalty notice on the other, and neither outcome reflects a tax strategy that was working in their favor. The practical correction for a freelancer who discovers a mid-year shortfall is to get current with the remaining scheduled payments, file Form 2210 with the annual return to show the IRS an accurate picture of the income pattern, and let a CPA calculate whether the annualized income installment method can reduce the penalty that has already accrued, rather than sending an outsized Q4 payment. In some cases, the penalty reduction from that calculation more than covers the cost of the professional advice. The 5-minute decision to send an impulsive large payment in January can cost more than a planned, calculated approach costs in CPA fees. 5 things, in the order they will actually help you, starting with the one that takes 15 minutes and requires no outside help. Pull out your most recent Form 1040, which is your annual federal tax return. Find line 11, which is your adjusted gross income, and line 24, which is your total tax. Those two numbers tell you everything you need to calculate your safe harbor baseline for this year. If your line 11 is $150,000 or below, your safe harbor target is 100% of line 24. If it is above $150,000, your target is 110% of line 24. Divide that target by 4, and that is the quarterly amount you need to pay to be protected from the underpayment penalty regardless of what this year's income looks like. The second step is to open your calendar right now and put all 4 quarterly deadlines in it with 2-week advance reminders for each one: April 15th, June 16th, September 15th, and January 15th. The 2-week buffer is not optional. It is the difference between a calculated payment and a panicked one, and a panicked payment is almost always too large or too small, and both errors cost money in different ways. The third step is to set up a separate savings account that holds only estimated tax money. Every time income arrives, move between 25 and 30% of the net amount into that account immediately before you spend any of it. That percentage accounts for federal income tax, self-employment tax, and a reasonable buffer for state taxes if your state has an income tax. Treating that account as untouchable except for quarterly payments means you will never find yourself in October without the money to make a Q3 or Q4 payment. This step alone eliminates the most common source of the overcorrection problem described in the 5th mistake. If you found this video useful, subscribing now means you will see the follow-up to this one, which goes through the specific Schedule C categories that freelancers at this income level miss most consistently, with dollar figures attached to each one. The 4th step is to find a CPA who works specifically with self-employed people and have one conversation with them before the end of this tax year. Not during tax season in March when their calendar is full, and the advice you receive is necessarily fast and generic. A conversation in October or November, when there is still time to act, is worth significantly more than a hurried one in April. Bring your prior year return, a rough estimate of this year's income and expenses, and a list of the questions this video raised for you. The questions themselves signal that you understand your situation well enough to have a productive conversation, and a good CPA will meet that level of preparation with specific, actionable guidance. The 5th step applies specifically to anyone who knows they have already underpaid this year. Do not send a corrective large payment without first understanding exactly how the IRS will apply it, because the penalty that has already accrued will not be erased by a larger December or January payment. What can potentially be reduced is the penalty calculation on the quarters where your income was genuinely lower than the standard installment method assumes, and Form 2210 and the annualized income installment method exist for exactly that situation. Whether they help you depends on the specifics of when you earned money this year, and that calculation is worth asking a CPA to run before you decide what to do with the Q4 payment. Most of the freelancers who receive an IRS penalty notice did not ignore their taxes. They paid them according to a set of assumptions about how the IRS calculates compliance that turned out to be incomplete, and the penalty is not punishment for negligence, but the consequence of a system that has specific rules, specific thresholds, and specific deadlines that were never explained to anyone when they made the transition from employee to self-employed. The information was always there, and the access to it was the part that was missing. That gap closes the moment you understand what the IRS is actually measuring, which is not whether you paid enough in total across the year, but whether you paid enough in each quarter based on when your income arrived. That one shift in how you think about estimated taxes changes every decision that follows, from when you set aside money to how much you send each quarter to whether you need a professional to run the annualized income installment calculation for you. One question worth leaving in the comments: which of the 5 mistakes in this video describes something you have already done, or something you realize you have been doing without knowing it was a rule? The answers to that question consistently point to the topics that are most useful to cover next. And this channel is built entirely around what people who watch it actually need to understand. Subscribing takes one click and means you will see the next video in this series as soon as it is available. The next one covers the Schedule C deductions that freelancers at the $30,000 to $150,000 income level miss most consistently, with specific dollar amounts attached to each category.